Hello, my name is Lindsay Hood and my presentation is on the Merrill Lynch scandal. On March 17, 2003, the Securities and Exchange Commission charged Merrill Lynch and 4 of its former senior executives with aiding and abetting Enron's securities fraud. The Commission's complaint alleges that Merrill Lynch and its former executives aided and abetted Enron's earning manipulation by engaging in 2 fraudulent year-end transactions in 1999. The transactions had the purpose and effect of overstating Enron's reported financial results. Enron used these transactions to add approximately $60 million to its fourth quarter of 1999 income, thus improving net income from $199 million to $259 million, and increasing its full year 1999 earnings per share from $1.09 to $1.17. The 4 former Merrill Lynch executives named in the complaint are Robert First, Schuler Tilney, Daniel Bailey, and Thomas Davis. The first transaction was an asset parking arrangement made on December 29, 1999. Merrill Lynch bought an interest in certain Nigerian barges from Enron with an express understanding that Enron would arrange for the sale of this interest by Merrill Lynch within 6 months at a specified rate of return. In substance, this transaction was at best a bridge loan because the risk and reward of ownership of the interest in the barges did not pass to Merrill Lynch. As further alleged in the complaint, Merrill Lynch and the named executives knew that Enron would record $28 million in revenue and $12 million in pre-tax income in connection with this transaction. The Commission alleged that Merrill Lynch and the named executives entered into this transaction solely to accommodate Enron, despite expressed concerns that Merrill Lynch could appear to be aiding and abetting Enron's earnings manipulation. In 2000, Enron arranged to take Merrill Lynch out of the barge deal on the agreed time frame at the agreed rate of return. In the second transaction, also closed in the last days of December 1999, Merrill Lynch and Enron entered into 2 energy options, one physical and one financial, that Merrill Lynch knew had the purpose and effect of inflating Enron's income by approximately $50 million. The complaint details that at year-end 1999, the trading under these options was not scheduled to begin for approximately 9 months. Before the transaction was closed, the complaint alleged, Enron told Merrill Lynch that despite a nominal term of 4 years, it might want to unwind this transaction early. Merrill Lynch believed that the 2 trades were essentially a wash and knew that the transaction would have a significant impact on Enron's reported results, bonuses, and stock price. Merrill Lynch demanded a multi-million-dollar fee for entering into this transaction. Enron ultimately agreed to pay Merrill Lynch a structured fee to be paid over 4 years with a net present value of $17 million. In 2000, Enron approached Merrill Lynch seeking to unwind the transaction before trading under the energy options was scheduled to begin. The deal was unwound in June 2000 after Merrill Lynch agreed to reduce its fee to $8.5 million to terminate the transaction. The SEC agreed to accept Merrill Lynch's offer to settle this matter. Merrill Lynch, without admitting or denying the allegations in the complaint, agreed to pay $80 million in disgorgement, penalties, and interest, and agreed to the entry of a permanent anti-fraud injunction prohibiting future violations of the federal securities laws. The Commission intended to have these funds paid into a court account pursuant to the Fair Fund provisions of Section 308A of the Sarbanes-Oxley Act of 2002 for ultimate distribution to the victims of the fraud. And here are my references. Thank you.